Cambridge Advanced Level Economics Revision. Unit 8, Government Microeconomic Intervention. This lesson is on equity and redistribution of income and wealth. Equity means fairness in the distribution of resources among the people. We can talk about equitable distribution of income, wealth, or government benefits. Equity has two aspects, namely horizontal equity and vertical equity. Horizontal equity applies when consumers or entities with the same circumstances pay the same level of taxation. Vertical equity means that taxes are fairly apportioned between the rich and the poor in the society. Equality. Equality means that everyone is treated in the same way. It is an ideal situation that can work only if everyone starts from the same position and needs the same help. People are not exposed to the same circumstances and opportunities, hence, achieving equality is difficult. Efficiency. It occurs when scarce resources are being used to produce maximum output. Efficiency can occur when firms produce at the lowest possible cost. This is referred to as productive efficiency. When firms produce goods and services that are most wanted by consumers, it is known as allocative efficiency. There is market failure when the market fails to allocate resources efficiently. Market failure requires government intervention. But intervention may lead to government failure, a situation that worsens the market failure. A policy such as road pricing charge reduces pollution, but creates inequality as both the low-income and high-income drivers pay the same level of charge. Poverty. Poverty means not having enough money or resources to experience a reasonable standard of living, e.g., food, housing, healthcare, education, etc. Poverty can be defined in many ways, e.g., extreme poverty, absolute poverty, and relative poverty. Cycle of poverty. It occurs when people born in poverty are much more likely to remain poor. Extreme poverty is a severe form of deprivation, which occurs when a person does not have the minimum income required to meet basic needs. It is measured against an international poverty line, which is updated from time to time. The new threshold is $3 per person per day as of June 2025 by the World Bank. A person is in extreme poverty if he lives on less than $3 per day. Absolute poverty. It occurs if a household income is below a certain level that makes it impossible to meet basic needs, e.g., food, water, education, and healthcare. The income level of absolute poverty varies from country to country. Relative poverty compares the income of a household with the average income for the country. Typically, a household is relatively poor if its income is 50% or less than the average income. The household standard of living is less than those households with incomes above 50% of the average. Policies towards equity and equality. Benefits to people on low income. Negative income tax. Benefits. The types of benefits are means-tested benefits, universal benefits, universal basic income. Means-tested benefits are paid only to those whose incomes fall below a certain level, e.g., unemployment benefits. They are claimed by only the needy, not everyone. Means-tested benefits, poverty trap. Poverty trap occurs when a person is better off on means-tested benefits rather than working. There is no incentive to work because disposable income is so little that it is better to just depend on benefits. Universal benefits. These benefits are available to all, irrespective of income and wealth, e.g., pension and child benefit. They are expensive as everyone is paid, including those who do not need it. Universal basic income is a relatively new type of benefit. A regular unconditional cash payment is made by the government, regardless of income or employment status. It reduces poverty or income inequality, while encouraging recipients to retain jobs or look for one. However, it is expensive as it is not for only the needy. Negative income tax. Money is paid out by the government to those earning below an agreed annual fixed benefit limit. The government pays the difference if tax is less than the fixed benefit. This applies to low-income earners. The tax is paid to the government if it is more than the fixed benefit for high-income earners. Negative income tax overcomes the problems with means-tested benefits and universal benefits.